What is up, everybody? Welcome back to Bitcoin and Markets. Happy FOMC Day. Hope you guys are all doing well out there. We're going to go through what the Fed decided to do. No big surprise. Going to look at the charts and go over some other stuff. The Bitcoin update from the White House was supposed to be today. I have my guys over on Telegram looking for that information. But let's get into the FOMC and see what they did today. Share my screen. And it's right here. And I'm going to share a different screen with Telegram. There we go. Okay. So you guys can find this just by Googling FOMC calendar, and it has all the information down here. We did not get an SEP, which is a summary of economic projections. That comes out every other meeting. And we got one last meeting. So the dot plot, that stuff was not updated. But then you just click in here to get the statement. And you can see committee decided to maintain target range for the Fed funds at 4.25% to 4.5%. So let's read through this, kind of translate the central bank language and go from there. So although swings in net exports continue to affect the data, so this is new verbiage. They're really worried about tariffs and how that's going to affect inflation or prices. It's not really inflation. Remember, inflation is money supply, but they count inflation as prices because they can't count the money supply anymore these days. That's one of the main bedrocks of my macro thesis is with esoteric money, shadow banking money, you can't actually count the amount of money out there. M2 is low-powered money. It's not even a full measure of money. M1, base money, all of those things are pretty much, they don't matter. They're inconsequential if the shadow banking system, which is the high-powered money, is malfunctioning, okay? So, and when you see a big pump in, let's say, M2, it's probably needed because of a shrinking of the shadow banking system, but they can't count the money is the point. That's why they have to focus on prices. And it gets us going down this road where we think of prices as some sort of, all prices are inflation. All prices are inflation, deflation. Same thing with tariffs, okay? Tariffs are, if they were to affect prices, they wouldn't be affecting prices through the supply of money function. They would be affecting prices through the just straight up supply of goods. Okay. And so is that even the proper thing for the Fed to target, right? Should the Fed even be worried about price movements from other things besides money supply? That's a big question that nobody seems to care about, but I think it's at the heart of what we're all doing here. So is that even an important thing? But the point is that the Fed has now gone down this road where forever and ever and ever they have been data dependent. And now they're not data dependent. They are actually theory dependent. Their theory is that tariffs will cause prices to go up. And so then they are doing their monetary policy, having that theory inform their monetary policy, not the data. It's completely backwards. And it's a big misstep, I think, from Powell. Even though I do think that he's been, until very recently, I think maybe the last 2 or 3 meetings, he has been the best Fed chair in my lifetime, at least. And so these last couple meetings have been a big misstep by Powell, but let's continue reading. Recent indicators suggest that growth of economic activity moderated in the first half of the year. Okay, growth, economic activity moderated first half of the year, but we did not really. We just got the Q2 number and it was 3% annualized. That's a decent GDP growth rate. Q1 was, I think it came in negative. I'm trying to remember off the top of my head. I think it was almost like 1% annualized negative. Q2 came in at 3% annualized positive. So I wouldn't say moderated. I would say there was a hiccup in the first quarter, and now it's come back. Um, anyway, let's continue. The unemployment rate remains low. Lots of stuff to say about the unemployment rate. There's different ways to measure unemployment. Even within the government, they have two different ways of measuring employment. They have the establishment survey and they have the household survey. And one measures payrolls, the establishment, and one measures house payrolls, and one measures workers. So if a worker has two jobs, it would count as two payrolls, but only one in the household survey. So there's different ways of counting this, and there's a big gap in these two. There's been a big gap for, I don't know, 8 years or something in these two surveys, and the household survey showing different levels of unemployment than the establishment survey. So we don't even know that. Plus, there's this problem of underemployment. That is, people say graduating college and not getting a job in their chosen career field. They have to go work as a waiter or waitress, and they can't get a job as marketing or accounting or whatever they graduated with. And so they are underemployed. Now, the amount of people underemployed is significant. There's also leaving the workforce. So people just have stopped looking for work. And this is becoming a huge concern for young men. Young men a lot are deciding to, hey, we can live with mom and dad, and we don't necessarily have to have a job. We can kind of slip outside of the system, maybe make some hustle money on the side, but they're not really in a career or anything like that. So they kind of fall out of these numbers. So the employment rate, I know that they try hard, and there's different forces within the government. Some might want to fudge the numbers. Some are really trying to make accurate numbers. But overall, I would say it's directionally correct. Same with CPI, except it doesn't take into account all those other factors that I just said. So they do the best they can, but it's very unclear. It's not clear enough to say that the unemployment rate remains low. That's what I would say. It's not clear enough to say that, because it could be 4%, which is, I think it's 4.1 is the official right now. But it could be as high as 6-8% if you take into consideration the labor force participation and all those things that I mentioned. And labor market conditions remain solid. Again, I don't think it's clear enough to say that, but they're just saying that to obviously jawbone the market into behaving itself. Remember, the main monetary policy from the Federal Reserve is jawboning. It is not the interest rates. It is this stuff. This is the main monetary policy. We're telling you that the unemployment rate is low. We're telling you that market conditions remain solid. And so then the market, they believe it. They also believe that inflation is kind of a self-fulfilling prophecy, that if you expect inflation to go up, inflation will go up. I'm just explaining their thought process. Okay. So that is what they are there for. They are there to manipulate how you view the market, how the market thinks it's doing. Okay. Inflation remains somewhat elevated, somewhat. I mean, okay. I think that is an okay term, but the path is down. Committee seeks to achieve maximum employment and inflation at a rate of 2% over the longer run. But again, inflation, as I started this out with, is it the Fed's job to target tariff prices? I would say no. I would say that is outside, that is political by definition, right? So if they're targeting a price change from tariffs, they are doing political action. They should only worry about price changes that are a result of monetary policy or monetary supply, in my opinion. I don't know why nobody has talked about that. Uncertainty about the economic outlook remains elevated. Well, it's getting better. We have a trade deal with the EU. I think, didn't we get one with the UK or whatever? Thailand and Cambodia seems to be wrapped up or handled. China is the big one that we're worried about now, and India, of course. So China and India. India is not so much of a concern because it's a smaller economy. I think it's only like 1.5 trillion economy versus Europe. Europe being what, 15 trillion. So that was a much bigger deal. India is a much less big deal. So overall, I would say the economic outlook, the uncertainty about the economic outlook is much lower right now than it was, say, last week or 2 weeks ago. The committee is attentive to the risks to both sides of its dual mandate. Also, remember, this is symmetrical 2%. So if it's below 2%, they're supposed to try to get it up. And if it's over 2%, they're supposed to try to get it down. Okay, we read that. In considering the extent and timing of additional adjustments to the target range federal funds rate, the committee will carefully assess incoming data. No, they are theory dependent right now, not data dependent. The evolving outlook and the balance of risks. The committee will continue reducing its holdings of Treasury securities, so they'll continue QT. Strongly committed, blah, 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 blah. I mean, this QT is kind of a thorn in the side of inflationistas because they think the Federal Reserve prints money. And so they think if the balance sheet is growing, that's the Federal Reserve printing money, but the balance sheet has been falling pretty substantially. And is that the Federal Reserve taking money out? And if that's the case, how do we still have somewhat elevated inflation? Okay, so all of these different things that fit together within this narrative that they're trying to weave don't make sense. It only makes sense, in my opinion, if you look at it from the fact that they don't really do anything. They don't really print money. All they do is try to manipulate the market with their jawboning. And they try to match these things up. They try to make you think that they're in charge. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information and economic outlook. Okay, so that's that. We have the FOMC pulled up here. Let's listen to a little bit of this. But before I do that, let's check the chat. Okay, this is from Spock. Although swings in net this is the changes, right? From last meeting to this meeting. Okay, so they changed have affected to continue to affect. Okay, so moderated in the first half of the year, they took out has continued to expand at a solid pace. Other than that, nothing really has changed. Okay, very interesting. So same boilerplate, except for those couple sentences. Thank you for that. Did anybody find the crypto report? Just waiting on that. But let's go back and listen to Powell dissect some of his Federal Reserve speak and make sure this is going to come through. One sec, guys. This one. There we go. Okay, let's play. Where are you, J Powell? Here he comes. Turn audio on.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments.
Well, they also have to have room to cut. I mean, they have plenty of room to cut, but that's the type of language I would expect to hear if, they're at 2% or they're at 1.5% and they see some possibility of recession in the next 6 to 12 months, then they would want to maintain room to cut. But at this point, they have a lot of room to cut. They're not going to be raising interest rates anytime soon. So I think that's kind of not necessarily what he said there.
Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year, down from 2.5% last year. Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak. In the labor market, conditions have remained solid. Payroll job gains averaged 150,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and has stayed in a narrow range over the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in June, and that, excluding the volatile food and energy categories, core PCE prices rose 2.7%. These readings are little changed from the beginning of the year, although the underlying composition of price changes has shifted. Services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people.
Yeah, stable prices, but stable prices from monetary policy, not political policy. For example, if the government, if the Congress or whoever wanted to pass something to increase price of good X, say energy, they want to put a tax on it, and they tax every gallon of gasoline, they tax it $1, okay? They add a new tax. Is Powell going to fight that with monetary policy and say, oh, no, the average gasoline gallon of gas now is from $3 to $4. We have to, that's inflation, and we need to raise rates? No, of course not. So what is the proper role of the Federal Reserve? I don't know. I'd have to go back and read the Federal Reserve Act and see if it says like part of their dual mandate is just prices, or is it monetary, it monetary caused inflation and not just prices in general, because I think that's pretty stupid if it is like that, because Like I said, if they put a tax on gasoline and it raises the price of gasoline, which raises the price of everything else, is that the proper role of the Federal Reserve to go in there and try to fight that price increase? No, I don't think so. Same thing, exact same thing with tariffs. It's just a different kind of tax, right? So is this proper? Rhetorical question.
At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks.
Mm-hmm.
Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level.
Okay, so here he's getting into the theory. He's saying we're seeing some effects on prices, but right there, you're admitting that your theory is not working. You know, like if you say, oh, my theory is for this to cause a general increase in the price, which is what inflation is, then, well, that's what they call inflation, then it's not doing that. So their theories are wrong, yet they're guiding their monetary policy off of these theories that are not showing up. And I don't think they're going to show up at all. I think tariffs are actually deflationary.
But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed.
Not data dependent. It's theory dependent.
Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks before adjusting our policy stance. We see our current policy stance as appropriate to guard against inflation risks.
As political. It's guarding against political prices.
We're also attentive to risks on the employment side of our mandate. In coming months, we will receive a good amount of data that will help inform our assessment of the balance of risks.
I think they're going to end up having to do an emergency cut. I think they are. Something's going to happen. I'm writing a post for the premium guys, and let's go to real quick to this one. So this is the Bitcoin price. Ooh, being affected negatively here. But I was looking at the 10-year, and if we go to the daily, look at this. I mean, I think something's going to happen, and they're my base case here. I'll draw an arrow, something like that. I don't know. This is getting close to the end, and if we go to other treasury bills like the 1 year or the 2 year, 2 years a little better. You can see the same sort of pattern. Okay. There's some tightening going on here, some coiling, and we're getting close to a decision point, mid-August or so. And if this, like if we have the 2 year and it drops out of this and they are holding rates steady, and we have the 2 year, something causes the 2 year to drop to 3%, which wouldn't be that crazy. I mean, look at back here. This dropped right here back in August of last year. How far did it drop? 16%. And so let's do this. How far would this be? 20%. 16% would be right there, 3.2. I mean, if we got something to cause this to drop like that, they could have some sort of emergency meeting because something's going wrong. Something's going wrong with the economy. Okay, let's go back. Play.
And the appropriate setting of the federal funds rate. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on potential revisions to our statement on longer-run goals and monetary policy strategy, and are on track to wrap up any modifications by late summer. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Chair Powell. There's a lot of lean in the markets, and not to mention out of the administration for a rate cut now in September. Is that
I was muted. That was kind of short.
expectation unrealistic at this point?
So, as you know, today we decided to leave our policy rate where it's been, where I would characterize as modestly restrictive. Inflation is running a bit above 2%, as I mentioned, even excluding tariff effects. The labor market's solid, historically low unemployment. Financial conditions are accommodative, and the economy is not performing as though restrictive policy were holding it back inappropriately. So it seems to me and to almost the whole committee that the economy is not performing as though restrictive policy is holding it back inappropriately, and modestly restrictive policy seems appropriate. All that said, there's also downside risk to the labor market. In coming months, we'll receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate.
So
Okay, one thing that I did share with Telegram, let's see if I can pull that up. The seasonality chart, which was a good one. And let's see if I can share this with YouTube. I think I can. All right, we'll share this. And Telegram, you're just going to have to watch Powell for right now. Okay, so let's see if I bring this up. Is that sharing? I think that's sharing. Okay. This is a seasonality chart of the S&P 500. So it's kind of like a combination of the 10 years of 2014 to 2024. And you can see seasonality. The stock market tends to peak in August and then roll over by the end of Q3. The big bottleneck, and then it goes up again towards the end of the year. That's the typical pattern that we see. Same thing here in the end of the first quarter. So you can tell why I think seasonality is a really important thing, because the bottlenecks always tend to happen in September, October, or March. Even maybe April, but March, I would say March, and then September, October. Those are the two bottlenecks of the year, and we're starting to approach the end of Q3. I mean, we're getting there. 1 out of 3 months is down. So if there is something to happen in the market, it will probably start showing up around the next month or two. That's my opinion. And again, I do expect a recession to be the next thing. I don't expect the economy to take off. I expect there to be a downturn before any sort of reflation or any sort of recovery. And how long can that go? Well, I don't know, because a lot of capital can flood into the United States from the rest of the world. We can have financial capital. We can have human capital coming over to the United States. And I think that will happen over the next 10, 20 years. And so the market might be buoyed just by that. Okay. And the rest of the world goes into a severe recession, which I think China is in right now. Europe is basically in there. Canada, basically in there. And so the rest of the world can have a significant recession, and the U.S. can kind of just sputter along. That's possible. But I do think the most likely outcome, the base case, is that the U.S. does not escape recession either, and the whole world goes into recession here before any sort of recovery. Okay, so that's enough of that seasonality. I thought that was a really interesting one. So let's go back and could you guys not see that on the stream? Oh man. Well, sorry if you couldn't see that. It's a good seasonality chart. How can I share that real quick? What if I download it and okay, and then what if I open it? Can I share that window? I think I can do it that way. Let's try. Just to see if you guys can see it. This one. There we go. I think that's sharing now. Yeah. So you can see the seasonality. August, it peaks in August and comes down. The end of Q3, really, I mean, it bottoms really close to the end of September, which is amazingly close to the end of Q3. And you can see the end of Q1 comes down here as well. So those are the two bottlenecks in the season, and that's what I'm watching for. So like I said, they might have to have an emergency cut. Well, if something like this starts happening and the yields start coming down uncontrollably, then they're going to have to do some sort of emergency cut. Okay, back to FOMC, and let's play.
Follow up by coming months. Does that include the possibility you'll be getting essentially 2 rounds of jobs and inflation data between now and the September meeting? Is that potentially adequate to make a decision to lower rates at that point?
So you're right. We do have, this is an intermeeting period when we'll get 2 full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Steve.
Thank you, Mr. Chairman. You took out the word or the notion that uncertainty has diminished from this state. Does that mean uncertainty has increased? And I'm just wondering, the administration has struck several deals with large trading partners where it seems like we now know what the rate is.
Okay, before we get into that, let's share this screen. This is the Cleveland Fed's inflation nowcasting, and they are having CPI expecting in July at 0.16. Remember, this is like important level because when you annualize this, it's under 2%. If you annualize 0.17, then it's over 2%, but 0.16 is under 2%. So that is what they're anticipating for July right now. Let's see how accurate they have been, because they haven't been super accurate if I remember correctly. Okay, so this is, they were underestimating last month. In May, they overestimated. Pretty close though. April, pretty close. I mean, they've been good recently here. Oh, they missed pretty big to the downside, or overestimated here in March. Let's see, February, overestimated February. Way underestimated in January. Kind of split. Okay, so it's kind of split from, if you go back to some of these earlier years, there were much bigger overemphasized misses. So anyway, let's go back to FOMC.
Is going to be. Does knowing that rate add to your certainty to change policy, or do you need to wait to see the economic effects?
So essentially the statement in our statement about uncertainty reflects what's gone on since the last meeting. So at the time of the last meeting, uncertainty had moved down a little bit, but it was more or less even this time. So we took out, had diminished because it didn't diminish further. So there's not really much in that. And then your second question is, say again?
There have been several deals that have been struck, and now we seem to have an idea of what the tariff rates are going to be with some of our large trading partners. Does that not add to the kind of certainty you might need, or is it you're waiting for the economic effects to show themselves?
He can't answer that. They have no idea how much uncertainty there is. What do you measure uncertainty in? It's just a feeling. Okay, there's no like units that you measure uncertainty in. It's all manipulation. They just took out some words to manipulate to get a different response from the market. That's all. That's all. They're not measuring uncertainty in any way.
Well, I think we're still, you're right, it's been a very dynamic time for these trade negotiations and lots and lots of events in the intermeeting period, but we're still, a ways away from seeing where things settle down. We are clearly getting more and more information, and I think at this point, people's estimates, our estimates, outside estimates of the likely, effective level of tariffs is not moving around that much at this point. But at the same time, there are many uncertainties left to resolve. So yes, we are learning more and more. It doesn't feel like we're very close to the end of that process, and that's not for us to judge. But it feels like there's much more to come.
Feels, or do we know? We don't know.
As well, looking ahead.
I mean, that doesn't instill very much confidence.
Hi, Mr. Chairman. Neil Irwin with Axios. This morning we got a GDP report in which final domestic private purchases decelerated, slowest pace since 22. There was a weakness in the interest-sensitive sectors and residential investment, commercial structures. Are those not signs that monetary policy is a little too restrictive right now, given current economic conditions?
So the GDP and PDFP numbers came in pretty much right where we expected them to come in. You got to look at the whole picture. So certainly, as I mentioned in my opening remarks, economic activity data, GDP, private domestic final purchases, which we think is a narrower but better signal.
Just think, he's like, you got to look at the whole picture, okay? But they want you to believe that they can control the whole picture. That's a very dynamic and complex system with one stinking number. Okay, you have to look at the whole picture. So we need to paint the narrative for you. Let's look at the whole picture. But then when we do change and we do something to help the market, it's with one number. The monetary policy rate. How crazy is that? How crazy is that to think? And then also, this goes back to the quantitative stuff, quantitative easing. So how do they know how many billions a month do they need? No, they just throw out a freaking round number. We need 80 billion this month, 40 billion, whatever. It's not quantitative at all. If it was quantitative, it would be 78 billion or 42 billion, 42.5 billion, but it's not. So they want you to believe that there's this complicated system and it reacts to their one policy tool, which is the monetary policy rate range. I mean, QE and QT as well. And they want you to believe that that's quantitative when it's all round numbers. And they move the policy range by quarter points. They don't move the policy range saying, okay, we need to dial this in 4.2 to 4.3. That's what we're doing the policy range at. No, they don't do that. They have this wide quarter point range that they moving up and down by quarter points or 50 basis points or whatever. And so it's just for anybody that's like neutral looking at this, they would say, how in the world is that possible? It's not. The market is fairly self-balancing. The market is fairly self-balancing, even with all of the intervention with the government and stuff. It's fairly self-balancing, and the Fed just jawbones around the margins. That's what they're doing.
For future, for where the economy is going, has come down to a little better than 1%, 1.2%, I think, in the case of GDP for the first half, whereas it was 2.5% last year. So that has certainly come down. But if you look at the labor market, what you see is, by many, many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market. You do see a slowing in job creation, but also a slowing in the supply of workers. So you've got a labor market that's in balance, albeit partially because both demand and supply for workers is coming down at the same pace, and that's why the unemployment rate has remained roughly stable, which is why I said we do see downside risk in the labor market. I mean, our two mandate variables, right, are inflation and maximum employment, stable prices and maximum employment, not so much growth. So the labor market looks solid. Inflation is above target, and even if you look through the tariff effects, we think it's still a bit above target, and that's why our stance is where it is. But as I mentioned, downside risks to the labor market are certainly apparent.
So on labor, given the fluid labor supply situation, is there a number for this jobs report we get on Friday that would look to you like equilibrium job growth?
The main number you have to look at now is the unemployment rate, because it's true that the demand for workers in the form of, let's call it, just say payroll jobs, that number has come down, but so has the break-even number, kind of in tandem. So, as long as that puts the labor market in balance, the fact that it's getting into balance due to
New York Times. Two of your colleagues called for a quarter-point cut today, and I'm wondering what aspects of their argument were most compelling to you, and how you're weighing their views against those on the committee who, as of the June forecast, were in the camp of the Fed holding interest rates steady for the remainder of the year. And just in terms of the June SEP in particular, is that still the best representation of where the core of the committee is?
So on the dissents, what you want from everybody, and
so there's
and
two
also
dissents.
from a dissenter, is a clear explanation of what your thinking is and what are the arguments you're making, and we had that today. So I think basically this was quite a good meeting all around the table, where people were thought carefully about this and put their positions out there. As I mentioned, the sort of the majority of the committee was of the view that inflation's a bit above target, maximum employment is at target. That calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now. But we had two dissenters who I think,
Yeah, but this is something I mentioned a couple weeks ago, and that is the lags. So they're all about their monetary policy transmission and how it lags. And once they start cutting, it takes a while to get worked in. Once they start raising, it takes a while for that to get worked in to the system. So he's talking about stuff that's right now and not concerned with monetary policy transmission. And lags. On top of that, they're being theory driven instead of data driven right now. So overall, it's kind of messy, man. He was rock solid for the first however many years he was in, 6 years or 7. How many years has been in? And so he was rock solid, and now he's kind of wavering. And this is very not credible, in my opinion.
want that clear thinking and expression of your thinking, and we certainly had that today. I think all around the table.
Yada, yada, yada.
In terms of
Does that mean that there's actually not much scope to reduce rates once the conditions for a cut are met, barring a significant weakening of the labor market?
So let me say, my own estimate is
Well, that's a good question.
modestly restrictive, and there are a range of views of what the neutral rate is at this moment for our economy, and so others may say it's more restrictive or less restrictive even. We're going to be at some point when we return to moving toward a more neutral stance, we'll be making that judgment as we go. I don't think we have a preset course. It's not so mechanical as saying, you know, we've derived with great confidence the neutral rate, and that is our.
Nick Timmer,
Okay, here's Nick Timros. He's supposed to be the Fed whisperer.
the Wall Street Journal. Chair Powell, my question is about what have you learned over the last few months about the inflation generating and price pass-through process? And just to drill down, the June CPI report showed evidence of tariff-induced goods inflation. Now, the tariff landscape is only starting to be settled with some of these more recent deals. Given the lags between when tariffs are announced and when they show up in goods prices, is 2 months a long enough horizon to evaluate the impact and be confident that tariffs aren't impacting the broader inflation process?
I think you have to think of this as still quite early days. And so I think what we're seeing now is substantial amounts of tariff revenue being collected on the order of $30 billion a month, which is, you know, substantially higher than before. And the evidence seems to be mostly not paid only to a small extent through exporters lowering their price, and companies or retailers, sort of people who are upstream, institutions that are upstream from the consumer, are paying most of this for now. Consumers it's starting to show up in consumer prices, as you know, in the June report. We expect to see more of that. And we know from surveys that companies feel that they have every intention of putting this through to the consumer, but you know, the truth is they may not be able to in many cases. So I think we're just going to have to watch and learn empirically how much of this and over what period of time. I think we've learned that the process will probably be slower than expected at the beginning, but we never expected it to be fast. We think we have a long way
Translation, they have no freaking clue.
to go to really understand exactly how it will be. So that's how we're thinking of it right now.
So if I could follow up, is the reticence to look through core goods inflation being driven by the judgment that during the pandemic expectations proved more adaptive than anyone at the Fed expected? Is it being driven by uncertainty over how restrictive policy is?
You could argue we are a bit looking through goods inflation by not raising rates. You know, we haven't reacted to new inflation, but I mean, I wouldn't insist upon that. But
New inflation.
I don't think. I think the base case. As I said, a reasonable base case is that these are one-time price effects. Of course, in the end, there will not be. This will not turn out to be inflation because we'll make sure that it's not. We will, through our tools, make sure that this does not move from being a one-time price increase to serious inflation. We want to do that efficiently, though, and that means we want to do it. If you move too soon, you wind up maybe not getting inflation all the way fixed, and you have to come back. That's inefficient. If you move too late, you might do unnecessary damage to the labor market. So there won't be, in the end, a big inflationary problem. What we're trying to do is accomplish that in a way that is efficient. But in the end, there should be no doubt that we will do what we need to do to keep inflation under control. Ideally, we do it efficiently.
Oh, well, there's not much confidence in you right now, pal. All this wishy-washy, we don't know. Uncertainty. That's not a way to get people to really think you got it under control there, buddy.
Michael McKee from Bloomberg Television and Radio. The one big bill, leaving aside the adjectives, do you expect it to add stimulus to the economy in 2026? And would that be an argument for remaining on hold or cutting back on the number of rate cuts you would expect for next year?
So, of course, let me just ritual disclaimer that we don't express any judgments or anything like on
I don't
fiscal
really care about
legislation,
this one.
legislation for that matter. But very often at the
Let's see. She asked a question.
Hi, Victoria Guida with Politico. When it comes to the renovations of the Federal Reserve's headquarters,
Okay, I don't really care about that either. How come I'm not getting a picture?
reservation at the National Capital Planning Commission, and a lot of back and forth there. It was very constructive. We started out to do the work, and we're very well along on numbers. And now goods inflation is going up. So the story has really changed. That's partially because of the tariff.
Not much. He's not saying much. Let's share this tab instead. We took a look at the yields. Let's see what's going on with the 10-year right now. Bouncing off the bottom of this pattern. We'll see how that ends up. Now let's take a closer look at Bitcoin. 116 I'm showing here. One thing that I have been watching is this gap, of course. The CME gap has not filled. Is a significant gap. So 115.6 down to 114. So $1,500 gap. Very reminiscent of this gap back here that kind of got filled, but not completely. And then we ended up taking off. We're already consolidating longer on this one, which I'm just super surprised that 120 became some sort of supply level, because it doesn't really make sense if you think about it. If you're an OG and why would you wait till 120 to sell? Why wouldn't you sell at 112 or whatever the last one was, this last consolidation range was? 120, I don't know who has that as some sort of big target that you would want to sell 80,000 Bitcoins. It just doesn't make sense. So the only thing that makes sense for those guys is that they're rolling them into some other project, most likely. They're not dumping them on the market, because if they were, this is the day that they dumped, right? The 25th, is that correct? And that was only a 1% down day. Is that the right one? Can't remember now which day it was, but it didn't really affect the price at all. And then Strategy is going out there buying. All these other companies are out there buying Bitcoin. ETFs are loading up in July. So far, they have bought $6 billion worth. So, I mean, there's tons of demand to soak up this 80,000, which is very bullish. But I just am surprised that this turned out to be the zone. Why 120? Why not 150? Right? Let's take a look at some other things here. The dollar really breaking out. Wow, this is a really big move in the dollar. Higher low, making a race for it right here. Let's turn on this moving average. That's the 50-day. You can see it provided resistance here. Didn't quite make it there. Resistance here, and just slashed right through it this time on a higher low. So this is a pretty big move in the dollar. Perhaps it will move quickly. If it does move quickly, it's going to cause a lot of problems internationally with the global financial system, because a lot of people are short dollars. Trillions and trillions worth short dollars out there. And if the dollar strengthens here relative to other currencies, it's really going to hurt those other countries. Okay. What do we got? And also this move. So if the dollar strengthens, say 15%, right, versus the euro, even if we go 10%, which is not that crazy, it makes those tariffs cheaper for us to afford, right? Makes the tariffs cheaper for us to afford because the dollar is strengthening. Okay, how about oil? Coming up, making a little bit of a move here, but nothing really significant. The downtrend is still intact completely. Getting some support in this support zone that we have been talking about for years now. Resistance turned back into support, so we will see where this ends up. Again, I have said that it will hit 50 before 90. So that's what I'm thinking about with oil. S&P 500, big down day. Let's see where it's gone in the last couple hours. Yeah, you can see the Fed decision right there, keeping rates steady. Interesting. Okay, so like I said a little bit earlier, I am working on a premium post for the guys over on the website. It is my daughter's birthday today, sweet 16. So we are going out to eat, and then I'll publish that post after that. So if you guys are waiting for that, I'll get it out this evening. And what else? So let's see if there's any comments. I hope this went streaming okay on YouTube because it's showing that I'm live on YouTube, but there's 0 comments coming through. And usually we get, a handful of comments. Let me check on Telegram and see what you guys are talking about over here. Okay, Spock did something else here. The water scent is coming. It will be due for the first time on July 1st, 2026. After months of debates, Prime Minister Marcus Soder and the cabinet decided in their last meeting before the summer break to introduce the water cent in Bavaria for uniformly 10 cents per cubic meter of groundwater pumped in the Free State, and is to be introduced on 1 January 2026. The German state of Bavaria will introduce a tax on water, groundwater, blue gold. Okay, well, yeah, should the ECB fight inflation because they're putting this new tax on it? Whatever. That was kind of the point. What is this one? Facey McFace. Ethereum's 10th anniversary. Come to the open house from 4 p.m. today. No, thank you. No, thank you. Jason says, when I jump on Nolan's show, which I might be doing here soon, let me check. He was sending me a DM, I thought. Let's see. Yeah, I have to get back with him. Hopefully that'll be soon. I should reiterate my view on the Fed. It follows markets, yeah. New walkout at UN conference in Geneva. What does this say? Arab, Iranian, and European delegations walk out of the UN parliamentary summit in Geneva after Israeli Knesset Speaker Amir told delegates the Palestinian state can be established in London or Paris. Okay. I don't really want to comment too much on that because I've already had one YouTube channel deleted. Bottom in for corn, guessing so, then pullback typical in September. Yeah, I feel like there's definitely pressure building up in Bitcoin to pop here pretty soon to the upside. If you guys are on YouTube, I'm reading the Telegram comments. 120K is roughly 100K in euros. Point. With a great point. Okay, what? It would be BTC euro, right? All right, let's see what we got here. Yes, dude. That's probably the answer right there. That is probably the answer. And look at this, is still under the all-time high from back here from January of this year, still below against the euro. Very interesting. Very, very interesting. So yeah, that's probably the reason. That probably is it. There's some OGs over there in Germany or something that are selling or rolling stuff over because that makes sense. This is a supply zone in euros. But can we see that? Can we see that volume? Let's see. It wouldn't be on the exchanges. It would have to be at OTC or something. And it wasn't it Galaxy or somebody? So I don't know. I don't know how we would be able to tell that, to be honest with you. We were chatting about this okay, I missed that. Congrats to your daughter. Oh, thank you, man. Yeah, she's driving. She went, you had to get a appointment to take your driver's test. And it has to be exactly 1 year after you get your permit. So you have to have your permit here in Florida for exactly 1 year or more, but you can't be less than a year. And so she went on her 15th birthday, got her permit exactly on the day. Then she got her appointment to go take her driver's test on her exact birthday. And so she has her driver's license. Pretty scary stuff. Scary stuff, man. I'm getting old. All right. So that's all I have for today, guys. Thanks for joining me. And I'll see you on the next one. Bye.